Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest and one of my idols in the space, Mr. Jefferson Lilly. Jefferson is a mobile home park investment expert and educator. He is responsible for Park Avenue Partners, strategic direction, acquisitions, and property operations. Prior to founding Park Avenue Partners, he co-founded Park Street Partners, a similar partnership also focused on acquiring mobile home parks nationwide. Both personally and through his partnerships, Jefferson has acquired 25 mobile home parks. This was as of when I read it off of your website, which may have increased since then, in 13 states since 2007, totaling over $56 million in value. He started the industry's very first podcast and the largest group on LinkedIn dedicated to investing in mobile home parks, which I will make sure to get you the link in the show notes to that. He holds a BA from the University of Pennsylvania and an MBA from the Wharton School of Business. Jefferson, welcome to the show.
Andrew, whatever I'm paying you, I'm doubling it. That was an astounding introduction, and actually about a third of it was actually accurate. So,
oh my goodness! Well, I'm so happy to have you, man. Your podcast was very important, in my education in the space. So, really excited to dive in today, and probably learn a couple things I don't know about you.
Fire away! Glad to be here.
Awesome. Can you please tell us about your story and how you got into manufactured housing?
Yeah. So when I woke up from the concussion, it just seemed like a good idea to buy a mobile home park. But no, seriously. So I got into the business. I got turned on to the space. It's now been about 15 years ago, 2005. I was working in high tech. I had been through the dot-com boom and bust and semi-resurgence. I was looking for some passive income to sort of even out, stock option income and what the stock market was doing. And I thought, well, I've always lived in a house or an apartment. Why don't I buy an apartment? I don't mind going to work. Maybe I'll fix it up, new roof on the building, new kitchens, make it better for the tenants, bump rents, make it better for me. And then just in being on websites like LoopNet, I would filter for multi-family properties. I live out here in San Francisco. I knew I was not going to find anything that cash flowed even then in San Francisco. So I was already looking, out in Lubbock, Texas, and Peoria, Illinois, and on and on. And I would see in these multi-family listings, 99 apartment buildings. Again, this is 2005 pricing. 99 apartment buildings at like an 8 cap. And then one trailer park at like a 10 or 12 cap. Probably that included some of the house income, and we can talk about that. I didn't know that at the time. But anyway, so I saw these asset classes, 1 in 100, that were, yielding 200, 300 basis points more. And of course, I thought, that's absurd. I'm not buying a friggin' trailer park. I deleted the search result and, looked in Omaha, Nebraska and Madison, Wisconsin. And I kept getting hit over the head. I'd be embarrassed. It probably took 5 or 10 of these little search results before I finally thought, I guess mobile home parks are multifamily, and why don't I look into it? Why these things seem to pay so much more money? Is it just that they're a huge hassle? What is it? So then I started looking around and found the Mobile Home University website back when its original founders, Corey Donaldson and Steve Case, were running MHU, and went to one of those and started buying pretty much every book and listening to tapes that I could find. And I built up an unofficial advisory board of about 10 guys that all owned mobile home parks. So I then it took roughly another year and a half. I wasn't really looking full time. I was still working my day job in tech. But I would run deals by these guys and they would say thumbs up or thumbs down. Here's why. Or maybe, don't know about this deal, Jefferson. Dig in on issue X. And when you figure that out, then you'll know, if it's a park you should buy. Anyway, so it took, I guess, about 17 months from the time I really kind of got turned on to the space and figured out, why it's a great little niche. In late '05, it took me until about March of '07 to close on my first park, about 17 months. Put in some other offers, got outbid along the way. I didn't chase up price on deals. But again, finally closed on my first deal in early '07. And again, it's kind of taken on a life of its own, from then doing some consulting to buying another park to then raising funds to now buying, I think I'm up to about 33 mobile home parks and hopefully closing on 3 more this Friday. We'll see.
3 in a day. Is it a portfolio?
Yeah, exactly.
Wow.
Yeah.
That's fantastic, man.
So we'll see. Yeah, I closed on 2 in a portfolio a week before last, and we've got 3 more, and we'll see if we can get it all done here by the end of the year. Fingers crossed.
Fingers crossed, man. Well, congratulations, dude. That's a fantastic story. Would you mind telling us a little bit about that park in 2007 and, how it fared during 2008, 2009? I think a lot of investors have heard of the recession-resistant characteristics the asset class has. But, it's not too often you get to speak to somebody that was an actual operator during that time. So if you wouldn't mind sharing some expertise, that'd be great.
Yeah, so this is my perfect business timing now, closing on my first investment with a very large chunk of my then net worth in March of '07. And then I think towards the end of that year and certainly into '08, the wheels came off the housing market, as it were. So yeah, I kept, I enforced no pay, no stay. I kept expecting my manager 1 month to call and sort of say like, hey, a third of the people haven't paid. Do you really want me to empty out your park by a third? Fortunately, that call never came. I got some other amusing calls, but that one never came. Folks continued generally to pay rent. There's always some single digit fraction of the folks that just can't bring themselves to pay rent. But that didn't increase that much. We might have had slightly more turnover. We continued to market the property. We pretty much always, since day one, have had a website for that property. And we were advertising on Craigslist. Facebook wasn't real big back then. But anyway, long story short, we stayed 95 to 100% full right through the Great Recession.
Wow.
We actually raised rents about 50%. I know that sounds extraordinary. This first park I bought had going in rents of $110 a month.
Wow.
Very modest. And that was 2007. By 2010, I believe we were at $155 a month. So still quite affordable. But percentage wise, that was a 50% increase. And again, we remained 95 to 100% full right through it. So, and that was in Oklahoma. And indeed, Oklahoma was not ground zero for the housing crisis. That was places more like Miami and Vegas and the eastern, I guess, sort of inland part of LA. What I hear, I know one other park owner who was active in Florida during that time. He had much higher turnover and therefore, had higher expenses renovating some of his homes. And I think he was more in the rental business, but he was closer to ground zero. He also remained over 90% occupied right through the housing recession. He worked it. He lived near his park. He was renovating houses. And again, there was higher turnover and some higher expenses, but still even he close to ground zero for the housing debacle didn't get wiped out. He worked a bit harder and he still got through it. I think cash flowing all the way.
That's fantastic. Thank you for sharing that. A lot of our listeners are passive investors. They've invested in other asset classes and they're not really aware of all of the risks involved in the mobile home park asset class.
Yeah.
So what are the most important things that passive investors or, LPs, if you want to call them, need to look out for, prior to investing either into a mobile home park syndication or a fund? What are the short list top items that you would like to share with those listeners?
Yeah. So honestly, I'd say the most important thing is doing diligence on your deal sponsor, on the GP, making sure that person is ethical and a good operator. I've long felt that, frankly, it's almost impossible to destroy the mobile home park business model. We've seen government come close, and we'll see how we get through this eviction moratorium. But the dynamics around the actual asset class are so strong. Really, there's greater risk in your GP, in the partnership. So I guess my advice to LPs would be get to know your GP, understand their ethics, understand how they operate, both how they source deals and how they operate them. Those are really the only two things, and you need to do both well, but finding good deals and operating them well are really the only two things you need to do to make money in this space. I would argue if you only do one of those well, you're not going to do that well on the whole. So some key questions to ask your GP would be, how are you sourcing deals? Are you getting deals off market? Or are you just buying the widely shopped deals from brokers? I've bought from brokers with my current fund. Given pricing, I've actually so far shifted to being able to find deals 100% off market.
Wow.
We'll see what the future holds. It's not that brokers have no good deals, but I'd be a little reticent to invest with somebody that exclusively just buys brokered deals and makes no effort to invest in the people and the systems to be cold calling and, again, sourcing deals on your own. So that's the first thing. And the second thing then is, how do you actually operate? There are some other operators. I don't think it's you and it's not me, but there's some operators out there that just outsource their properties entirely to property management companies. I've never done that with a whole portfolio. I've done it with a couple of properties, and I bought one property that came with an outside management company, and we are in the process of replacing them. So I would say that it's really not a good long-term strategy to just outsource your management. Frankly, this business just isn't that easy. Outside management companies can maintain a property, but in today's market, with today's pricing, you're probably paying still a pretty decent price. You've really got to take the property to the next level. You cannot any longer, in general, just sit back and cash flow and do nothing but raise rents, right? You've got to actually be fixing houses. You've got to be buying new and getting those transported in. You got to get the website set up. You got to advertise on Craigslist and Facebook and so on. So I would say, obviously I'm biased, but I would say that LPs should really be investing with partnerships that find almost entirely off-market deals. Those are likely to be priced better. And you can actually close those deals, usually close those quicker. And then again, invest in partnerships that actually keep the management in-house.
Those are two extremely good pieces of advice. So thank you for sharing that. I agree with you on both of them. I think I read something where more mobile home parks trade off market than on market, which is quite interesting. But yeah, the third party management, we had one community that was third party managed when we acquired it, and it's just a very tough cookie. It's not your typical residential, single family house portfolio. There's a lot more moving pieces.
More moving parts.
Yes.
Some of those parts actually have wheels. Yeah. Management companies don't do well with wheel estate. They tend to do okay with real estate, but the wheel estate part of our business, I have found, has confounded most outside management companies.
Totally. So Jefferson, what has been the toughest hurdle in your business, for you guys?
I think it's all really, for me, revolves around people and hiring people and motivating them and building a culture. This business is relatively easy to get into if you're a sole practitioner and you want to buy a park of 50 pads or 100 pads. That's how I got started. And it's easy to sort of do everything, right? You're answering the phone, or you're calling the plumber, or you're posting the ads on Craigslist. And but where you get certainly over a couple hundred pads, and I would say generally, at least my experience, when you get to about 500 pads, you can no longer, be Superman. I probably have a really bad Superman complex. I think I can do it all. And in fact, given an infinite amount of time, sure, I could do it all. I could do all the accounting, I could answer all the phone calls, I could do all the marketing, but there just aren't enough hours in the day. And so I call it Mobile Home Park 2.0, and I've done a podcast on it. But all the Mobile Home University and all the books and everything out there help you get to Mobile Home Park 1.0. Why is this a great business? Where do you advertise a home for sale? That kind of stuff. Nobody's really teaching Mobile Home Park 2.0. How do you now build an organization so that you as the founder really step out of the mobile home park business, and you get into more of being a headhunter, a recruiter, and a manager of people that in turn do all the accounting, marketing, rehab, and whatnot. That's quite a stretch. I haven't found it easy to do. I think I'm getting better at it, but I've still got a long way to go. But just getting to Mobile Home Park 2.0, getting beyond the 400 or 500 pad mark, and really having to hire and motivate the right people is, I think, always a challenge.
Totally agree with you on that. That's been, one of the tougher things for us as well. In another life, I worked a lot with Keller Williams real estate agents, and Gary Keller, wrote a book on how to grow your team. This is your first hire. This is your next hire, right? There's nothing like that in the mobile home park business, like you're saying. So I did enjoy your podcast, Mobile Home Park 2.0. And I think you gave a presentation at Seco either this year or last year on that as well. So if I'll put a link into the show notes of that so they can get over and check that out if they're interested. Fantastic. Well, what can you tell us about the current state of the mobile home park industry and manufactured housing in general? And where do you see it going into the foreseeable future?
So the business generally is consolidating. It's still, a fair number of mom and pop operators, but I certainly see a much greater competition for deals than I did, say, 12, 13 years ago when I got into the business. And again, as I alluded earlier, it's becoming increasingly important to execute. We're nowhere near doing deals as big as, stuff that was done back in the 80s. But, with all the RJR takeover and KKR and all these guys, you saw an evolution from it being initially in most of the 80s, big buyouts, just about financial engineering. And all these people that, were investment bankers and could raise money, slap debt on a company, take it private, tinker with the finances a bit and sell it at a profit, but they weren't really operating the business. And then you had firms more like Bain Capital come along that actually paid up a pretty penny, a big price for deals, and then actually went in and operated those businesses. So we're not doing deals, anywhere near into the billions. Most of my deals, at least, are single digit millions. But again, it's this business has evolved from just saying, "Hey, I just want to buy a park and then do nothing," as if it's a passive investment. If you were buying at the prices, circa 2010, probably you could just buy, be passive, and do nothing. But again, today you're probably not getting great deals price wise. Better still if you're buying off market, but you're rarely stealing a deal. And again, you need to really operate it, get a good manager in there, get a good compensation plan for them, and get them motivated to be bringing in and renovating houses and all these operational issues. So you've got to be a much better operator today than you did, say, 10 and certainly even 5 years ago. And then I think what we're seeing also then as the business consolidates is it makes some of the exits perhaps a little more interesting. All of our numbers with our LPs are predicated on selling deals one at a time, say at the end of our 10-year fund, selling deals one at a time at basically the same cap rate that we bought them at. Now, presumably we're making more money. We're going to get some operating leverage. Anyway, it's not baked into any of our numbers, but I suspect what we'll see increasingly, and certainly 5 and 10 years down the road when we might be exiting some of our funds, is that you'll see some of these larger operators, even larger than we are, paying lower cap rates to buy a portfolio of properties. And so I think I've seen more of that happening than, again, say 5 or 10 years ago. So we think, we don't plan on it, but we think we'll not only have the operating leverage of improving the properties, but we think we'll actually be able to sell them probably at a lower cap rate and get some financial leverage. So that's been a change, that there are portfolio buyers, and that portfolios generally trade at a higher price, lower cap rate than the individual properties. So again, there's value to building just a larger portfolio in general. And for instance, we've been able to concentrate some, for instance, with our current Park Avenue fund, we've now acquired 5 properties in Sioux City, Iowa. Wow. So for a future operator, that's great to have. Now we're a little over 400 pads between those 5 properties, and they're all within about a 4-mile radius of one another. And we're looking at some other acquisitions in metros that we're already in. So it's not a must, but I think there's some unique benefit today and again at exit in the future as it continues to consolidate, to having really a portfolio of properties that you can sell off in a bundle.
Totally. No, that's fantastic. Would you mind touching on the value add that you guys implement in your new acquisitions? Some of our other guests on the podcast have mentioned how, infill is one of the tougher value add components. Would you mind sharing a little bit about, what you guys employ in your properties?
Yeah. So the big 3 for all of us are basically bumping rents. That's the easiest. Obviously doesn't take hardly any effort to just send out a letter and say, hey, fair market is now $20 higher. Your rent's gone up. So rent increases, that's the easiest. Even someone not strong at operations can raise rents. Secondly, then, kind of going down the list of low-hanging fruit, what's slightly less low-hanging is to actually install water meters. We've found with our portfolio so far, it's approximately half that has upside from installing water meters. The other half, either the meters are already there, or, of course, the beautiful thing is that the local utility is billing tenants directly for their utilities, and then you've got a pure parking lot. So that's a fair amount of our Sioux City portfolio, thankfully. But anyway, but we'll actually install water meters, and those are remote read, wireless, so they feed back into our system, our rent accounting system. We happen to use Rent Manager. Appfolio is also good. Yardi, there are half a dozen of these. Anyway, we happen to use Rent Manager, but that's a big plus to just get the wireless reads and not have to, first off, of course, to bill for the water. And then again, to not have to actually bother a manager with going around and manually reading meters. We want our managers focused on, selling houses and maintaining curb appeal, not on doing manual things like reading meters. Anyway, so water meters is the second thing that we do. And then the third thing, as you alluded to, is infill. That is the heavy lifting in this business. We've, over the last couple of months, actually over about the last year, we've ordered almost 20 brand new homes, and we anticipate escalating that and buying far more over the next 12 months as we continue to acquire properties. But buying new is easier, but still requires logistics around, getting the home delivered and set and skirted and plumbed and electrified and on and marketed. Anyway, so what we may do, frankly, over the next maybe even 6 months is hire somebody just to source mobile homes for us, new and used, and coordinate, again, the moves, the set. For used homes, they would also be coordinating a rehab. And again, just have somebody who just infills our parks. That's, again, not something that an outside management company can really do a good job of. And we've had some of our managers, find onesie, twosie homes to buy, which is great. But I think we're about at the scale where we can probably create a decent, high five, maybe even six-figure income for somebody just sourcing homes and getting them into our parks. Anyway, so that's the third thing. So you got rents, water meters, and the heavy lifting, real heavy lifting of infill.
That's great. That's wonderful. Jefferson, what does the perfect mobile home park look like in your eyes?
It's free. It's got a treasure chest of gold and diamonds buried in it. Only I know where that is.
Yeah, it's a 20 cap.
It's free. What do you just get one for free? But no, I think realistically, we at least like to buy, let's say, roughly stabilized with upside. So something that's around 80% occupied, probably very few park-owned homes, and to get it at a reasonable price. So we love things that are into the double-digit cap rates. We've been able to find a couple of those. And then again, with 20%, let's say all the infrastructure is there. So the extra 20% of the pads are fully constructed. All the utility headers are there. And all we have to do is source and bring in homes. And then, of course, it'd be nice if all of those additional vacant pads are also direct billed by the utility company. And then so that's the park itself. Thinking outside the park, we would want that to be located in a decent metro. Decent for us means average house price of $100,000 and up. Average a site-built house. So, and we're in some metros where it's closer to $200,000. We've done one or two deals where the average house price is $250,000.
Wow.
But anything well over $100,000 means you got a pretty healthy economy. And then we also like to be within about 5 miles of a super Walmart. Walmart, we think, does their demographic and economic research quite well, and super Walmarts are put in places that are reasonably healthy economically. One of our better deals was 0 miles to the super Walmart. Our northern border of our property was the southern border of the super Walmart parking lot, and that super Walmart had been a super Walmart for 20 years, 30 years or something, and had actually been torn down and rebuilt larger.
Wow.
About 6 years prior to us acquiring the park. So again, if Walmart's investing that way in a super Walmart, you probably got a pretty decent economy there. So that's our perfect deal.
That's great. What is the value proposition at Park Avenue Partners, and what makes your operation different?
So unlike most other partnerships, we take no fees. I get no salary. I get no acquisition fee. I get no back-end divestiture fee. We are truly aligned with our limited partners. We split the profits 50-50. That's both cash flow quarterly as well as no guarantees, but presumably some much larger checks at the end of the fund at the end of 10 years. Again, we focus on mobile home parks. We aren't also dabbling in single family or apartment or self-storage. We focus on mobile home parks. And then again, we've been, at least so far, able to source deals exclusively off market. And we again operate those entirely in-house. So we think that'll lead to the best long-term results. Again, both managing in-house, but also having the discipline to not be motivated by fees, right? If I go out and do a $10 million deal, I'm not pocketing a $200,000 or greater finder's fee, so to speak, acquisition fee. The deals we do have got to actually cash flow. So again, I think we've got better alignment with our limited partners than most other funds, because there are no fees, no salary. We're just true partners in the deal.
Wonderful. Jefferson, thank you so much for coming on the show. If any of our listeners would like to get a hold of you, what is the best way for them to do so?
Yeah, so our fund website is simply parkavenuepartners.com. And there's actually, I think at the bottom of our homepage, there's an intake form. Somebody can just fill out their information and ping me directly through the website. There's also up at the top of the website just a little subscribe button, and folks can join our mailing list. Honestly, I probably don't do as much email as I should. It'll be almost certainly less than one email a month. We don't spam, but that's how folks can get appraised of our deals and upcoming fund, which we hope to launch in about Q2 of 2021, about another 6 months. So parkavenuepartners.com. And then you alluded to the podcast and the LinkedIn group. And I've also got a calendar of events that people can download as well. Anyway, all that is at mobilehomeparkinvestors.com. mobilehomeparkinvestors.com. And there they can find the links to LinkedIn and our podcast and the industry calendar of events.
Awesome. And please, make sure to check out Jefferson's LinkedIn group. That's titled Mobile Home Park Investors, and it has over 5,700 members to date. And there's a lot of valuable information in there. So that does it for today's show. Jefferson, thank you again for joining us. And to all you listeners, thank you so much for tuning in.
Thanks, Andrew. You're the best.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.